In this video, we're going to look at what is dollar cost averaging. Stay tuned. Hey traders, a very warm welcome to you. So dollar cost averaging is a way of getting involved in the stock market or an individual share or a basket of shares in an average way over a long period of time. It takes a lot of the risk out, and instead of just piling all your money in, allows you to kind of spread and cancel out or dampen down the noise of volatility from month to month. Let's have a look at what it is and some examples of how it could work. Okay, so you buy a fixed amount of shares. Let me get a nice purple pen for you. You buy a fixed amount of shares or stock or whatever, or units of a unit trust every time period at set intervals, e.g. monthly. Monthly is the most common one. So for example, people are making a monthly income who want to invest in a company, and this could be an individual stock like Apple or Tesla or Tesco's or Vodafone, whatever you've kind of thought. Could be a basket of stocks that you've set out, a little portfolio you want to buy a broad amount, a little chunk of your money in each. It could be an ETF, which does the same thing for you, but is all bundled up ready. Which could be in a specific sector like retail or tech, or could be kind of tracking a broader fund like the S&P 500 or India or Brazil or whatever. We've got a broad amount of ETFs we can trade from, and I've done a video on that before. Or it could be an actual unit trust, a hedge fund that allows you to buy units. Normally there's a minimum amount you can buy of that, but it's the same kind of thing. In other words, you're just getting exposure to the market. So you've got a fixed amount and it's at set intervals, and it's normally monthly. So really what happens is, as price rises, you're buying less shares. So let's say we are just looking at one specific stock, and you could extrapolate this out into more, but let's look at one specific stock. As the price rises, you're buying your fixed £1,000 worth. Let's say we're using £1,000 worth a month, every month. Of course, as the price gets higher, you get less shares for your £1,000, so you're buying less. As the price falls, you're buying more shares. So it kind of prevents you chasing too high as well, but it gives you more shares when price is lower, but you can see how it kind of averages it out for you. But let's have a look at a good example over here. Okay, we've got 1, 2, 3, 4, 5 months, and you're investing £5,000. You're investing £5,000 total, £1,000 a month into this specific stock, share, whatever it may be that you've identified that you want to invest in. So month one, it's at £20 a share, and you buy yourself 50 units of that, and you've invested £1,000. So month two, you go, okay, it's now moved down to £16 a share. I can buy a few more shares. I buy 63 shares with that. Now, of course, I rounded it very, very slightly because you can't buy halves of shares, but it's close enough. So you've got £2,000 in the market at the moment. Month three, it's gone down even lower to £12 a share, and it allows you to buy 83 shares for your £1,000 investment. And then month four, it's lifted up a little bit, a few less shares. So you're on 59, so that's month three there, that's month four there. And then month five, the final month, has gone back up to 23, highest of the lot, and you can only buy 43 shares. So after that 5-month period, your £5,000 has been split into 5 individual transactions. You have bought 298 shares, which is the sum of all the shares there, and your average price is $16.77. So you can see that at the end of this period, if the price is 23, you've made a nice bit of profit on that. In this example, you've got 298 shares and you made a profit between 23 minus 16.77, whatever that is. Put it in the comments section below, save me getting the calculator out. But the point is, if you'd gone in your £5,000 and put it in at 20 or at 16 or 12, yes, you potentially could have made some money if you'd gone all in at 12, but this dampens down the risk a little bit. If you bought them all at 20, you're not going to be anywhere near as profitable as the fact that you've bought all these at 16.77. So it's a way of investing frequently in something that you want to invest in without having to time it too much. You just literally say, hey, that's a good investment. That's exactly what I want to trade. That's exactly what I want to get involved in. Okay, now I'm going to buy that over a year period, a 6-month period, a quarter period, whatever it may be. So I'm going to get an average over that time, which eliminates the need for me to try and time things too much, which can be a challenge and can be the difference between making money and losing money. If you end up buying at the peak, you either losing money because it's coming down the trough, or you don't think you want to buy it because it might go up. It just eliminates that psychological aspect for it. A really good kind of way of getting involved. Dollar cost averaging, guys, that's it. Let me know your thoughts in the comment section below. I'll see you in the next one. Take care. Bye-bye.